Well, hi, hello everyone. My name is Cliff Freeman of the Cliff Freeman Group, and today is Sunday, March 19th, 2023. I wanted to get a little head start on the week. There's a bunch of crazy things going on out in the market, including the collapse of a couple of banks that I'm going to talk about, as well as interest rates, things in the Ukraine, things with China and Russia. Goodness gracious, who knows what's going to be going on in the rest of the year, but I have a plan here, and I've created this video called How Higher Rates Can Be a Benefit to a Buyer. And I'm going to walk you through a couple of scenarios here. And if you're a buyer in any market here, but particularly the Dallas-Fort Worth area, we're ready to help you with strategies just like this to make sure you get the perfect house at the perfect price. So let's go ahead and begin the presentation here and talk about what's been going on recently. You know, we've seen the collapse of the Silicon Valley Bank, Signature Bank in New York, and, crypto has been all over the place and has been accused of being one of the causes for these banks to go under. And then this term called moral hazard sort of came into play. And, it's one of those things. It's not something that really has to do with morality, but the strict definition of moral hazard is a lack of incentive to guard against risk where one is protected from its consequences, or in this case, the banks being protected by the government. And that's what we're seeing happening here. And so if we take a further look, we'll see that the two banks at the bottom, Signature Bank and Silicon Valley Bank, had the highest share of deposits that were greater than $250,000 as a percentage of total deposits. In other words, this actually shows the share of deposits less than 250,000 a percentage, but flip it over and you'll see that these two banks had way larger accounts than were guaranteed by the FDIC. So what happens? Well, the government steps in, and again, too big to fail. So this is where that term moral hazard has come into play, and a lot of people think that we could be on the verge of seeing more bailouts here in the future. As the current week begins, we've seen a drop in rates that was driven not only by a flight to safety or into Treasury securities because of this bank fiasco, but also because of the expectation that the Fed is going to perhaps start cutting rates by the end of the year. And what we actually see here is, if you look closely at this graph, the September expectation of rates by the Fed, we see that as coming way down. So we're starting to see indications the market believes that the Fed could start cutting here. Now, it's okay. We're seeing a little bit of a decrease now. We saw about a 50 to 75 point decrease, basis points decrease in rates at the end of last week. But the key thing to remember here, I know it's a little one, but most of these sustainable improvements in mortgage rates happen gradually. And, our housing market is already responding to the ceiling in rates that we've seen. In other words, we haven't really broken through 7, but ever since the highs that we saw back in late 2022, housing metrics have begun to slowly come off their lower levels, as we'll see here in the next slide. So take a look at these and see. Yes, I know it's a small little decline here. However, it's a beginning of a good start. And also notice here that builder confidence, which reached a low of around 30, is now up almost to 45. So those are all bullish signs in the housing market that things are going to get better. In other words, even the builders are believing that the Fed is going to be relaxing things here as we go in toward the second half of 2023. All right. So if we just look here from September of last year, we can see that inflation is definitely on its way down. What is it that drives mortgage rates? Well, it's inflation. And it's certainly not in a straight line here. We can see that, and perhaps it's not coming down as quickly as we would like, but eventually inflation will continue lower, and that will move mortgage rates to more attractive levels. Now, the question is, what's the holdup here? How come we haven't seen rates go down since September of 2022? So let's start with shelter cost. Shelter costs lag. Let's take a look at what's happening and how it's measured. Shelter costs are typically measured by rents and owner's equivalent rents. Those are the predominant drivers in the shelter components. Now, as you can see, the cost of rents and owner's equivalent rent has gone up dramatically here. But after peaking in early 2022, they have eased up significantly. And now the year-over-year rate is just 3%. The problem with this is that when we look at the way that this is measured, it counts the last 12 months. And what's even worse than that is that although you may have to go back to 2011 to 12 months when the survey occurred, it's quite possible that they may have signed their lease before that. So this may have been the rent that they are paying effectively, but it may also be reflective of when they signed their lease. So you really need to have have a long lag period. It could be a year and a half in lag for this to catch up. So while we know in real time, and eventually there will be a catch up, we see the cost of shelter easing the way that it's reported in CPI, especially core CPI, which is going to drive the direction of mortgage rates. We know there's a lag. At the front of the roller coaster, when it reaches the apex, could be heading lower, but that's the front here, could be heading lower, but the back is still pointing up, as you can see here. That's kind of like the way real shelter costs are behaving compared to where it's being reported in the CPI. And here's the way it's being reported in the CPI. As you can see, this blue line here is how it's reflected in the CPI. There we go. And it's still reflecting a lot of pressure for shelter costs. And that is artificially pushing CPI, or you can really do a calculation on this. The shelter component makes up 43% of core CPI. So this is a very, very big weighting. And the difference here can be calculated as the difference between the two of 4.9%. That's 7.9 minus 3. When you take into consideration the weighting, it's actually pushing CPI up about 2% higher than it should be. So CPI right now is around 5.5% rather, on core CPI. It's really as if we were taking the real-time read on shelter costs. If we were taking that, it should be about 3.5. So the point being is that eventually this does catch up. Eventually, we will see CPI core move lower, and that should help mortgage rates move to significantly lower levels. All right. Now, meanwhile, if you have lower mortgage rates, what will that do to the housing market? Well, this illustrates home inventory in the current marketplace, and it's really tight, as everybody knows. A lot of people like to talk about bubble conditions. Well, when you start to take a look at when we were in a housing bubble, certainly it was problematic because there were just too many homes and not enough buyers. When you take a look at the amount of homes available in 2007, there were 4 million units for sale. Today, we have less than 1 million. Now, at the same time, our population has grown, so we have a very, very tight inventory environment. And the bottom line here is that if rates do drop and you see an increase in buyer activity, they're going to be looking at extremely tight inventory, and that spells multiple offers and upside pricing pressure. All right. But even With that 980,000 units in home inventory that is currently reported, check this out. What's not shown is that about 40% of those currently are under contract, so they're off market. You can't really buy those. When you take a look at active listings, what we can pick and choose from is only about 578,000 homes. So our population is growing. It's near 340 million people, and yet active listings to choose from is just 578,000. That, my friends, is slim pickings. So if you can increase the buyer activity through lower interest rates, and that will happen as inflation comes down, there's going to be a lot of upside pressure. It's all about supply and demand. So take a look just from a comparative point of view. This is what active listings look like now. And this represents a more normal marketplace over here. You can see there. Certainly real estate values have gone up during this period, but they've really accelerated here in the times of low inventory. Here we are again, low inventory, and now we won't expect that 3% mortgage environment back anytime soon, but perhaps somewhere in the 5% range should crank up the demand quite a bit in a very low supply environment. So look, we've seen home values increase for over 10 years consecutively. That's like 121 straight months of home values going up. But in the second half of 2022, they've come down modestly. So it depends on the measurement you look at. If you look at FHFA, they've come down about 1%. If you look at Case-Shiller, the home price index, it's about 2.7%. Now, those are on a seasonally adjusted basis because they're taken at the end of the year, and it usually has softer levels of appreciation or even prices coming in a bit. On a year-over-year basis, rather, home values are still going up. If rates do reach a level that they can start coming down, well, then home values will not be coming down any longer. They'll start going up. So will there be a bottom in the very near future? Now, let's assume none of us are good enough to pick the exact date of the bottom. And let's be resigned to the fact, okay, that we're going to miss the bottom. So what most people do, they wait until the bottom occurs, right? They wait till the bottom occurs. And by then, then they wait till they're there's the all clear. In other words, you know for sure that things are going to go back up, and they wait until prices start going back up to jump back into the market, right? So the problem with that is that sellers are more confident after the bottom. There's more competition. There's multiple offers. So you're not going to get as good of a deal after the bottom as you are here going on the downside, getting to the bottom. Okay, it's kind of like Wayne Gretzky said, you got to skate where the puck is, know where the puck is going, right? Okay, so the trick is to see the future before it becomes obvious. And if we realize that mortgage rates will drive demand in a very tight supply environment like we have now, well, then as inflation comes down, mortgage rates should come down. And we want to take advantage of this time where there's a little bit of fear and a little bit of weakness in housing and enter the market before the bottom, because sellers are more fearful at this time. They'll be more willing to give you a discount. There's less competition. Even though the market is scarce with inventory, it does afford more choices than after the bottom when more buyers enter. So really, folks, this is the ideal time. And let's take a look at a case study now. Now, if we looked at a case study at the last time we had a market bottom during the cycle, you could see prices were coming down and bottomed out in early 2012. before starting to move up higher. But notice that the acceleration up was much greater right in here once the bottom was hit. That's because once people started to enter, it really drove prices higher. In fact, in the next year, from the bottom, prices went up 8%. 8% in 1 year. That's what I would call robust. But inventory levels at the time in 2012 were at 2.4 million. Now, where we are during this market bottom is less than 1 million. So we've got far fewer homes available. So do we get a similar level of gain? Do we get a greater level of gain? It's very difficult to forecast, but I would say it's safe to say that prices will be supportive. And even with 2.4 million homes in inventory, we saw 8% appreciation in the next year. Let's be very conservative and say we only get 3%. Okay, so not 8%, not more than 8% because there's less inventory than even 5%. Let's just say 3%. Okay? Now, see the graph here. So this is 8% year over year, even with 2.4 million in inventory, and now we have less than 1 million. All right, so let's say you have a home value of $500,000, and let's just say we're taking a mortgage out, 20% down, of $400,000, just for some easy round numbers. Now, rates are elevated. They're about 1% higher than they were recently, although they've come down, as we've talked about here recently with the failure of Silicon Valley Bank and Signature Bank. So even though they're coming down a bit, it's still going to cost people a little bit more money than it did 6-8 months ago, and it's keeping people a little bit more bashful and at bay. So the monthly payment increased based on that 1% on a $400,000 mortgage is about $250, 257 or so. Now, if it were year over year, you could take that times 12 and be a little over $3,000. So that would be the cost of the higher mortgage rate at right now. But hold on a second right now, because we're in an environment where sellers are more concerned, willing to negotiate a little bit more. There's a lot of negativity in the media. You could probably get a discount. We're actually seeing sellers in the field right now offering seller concessions, and it's happening more often than not. Maybe it's 2%, maybe it's around 2%. Again, Case Schiller says that we're down 2.7, FHFA says 1. So let's just pick 2% as a discount on a $500,000 home. That's a $10,000 savings. Okay. Now, certainly there's ways to be creative and to get more of a value if you use it towards seller contributions, say as a buy down or towards a permanent buy down. There can be ways to actually make this more valuable. Well, let's just say there's $10,000 in savings. Now, as we hit bottom in the very near future and values start going up, remember I showed you that the last cycle bottom, it went up 8%, but let's say it's only going to go up 3%. So instead of getting a 2% discount, you get a 2% increase while you add the two together. And then subtract from that the cost of paying the higher 1% mortgage rate, and even throw in the cost of refinancing. Let's just round it off, because who knows what it's going to be in less than a year, right? So just some round numbers here. If there's a $5,000 cost, your $10,000 savings and $15,000 appreciation comes to a $25,000 benefit with a $5,000 cost. So this seems like a pretty good opportunity that exists in housing right now. Okay? So that's a $20,000 gain just based on where we believe things are going to be going toward the end of the year. and before we hit bottom here. So the time is now, and you've got to see this opportunity. You've got to see the future before it comes obvious, because if you wait until after the bottom, things are going to get very, very, very tight. All right. So let's take advantage of it now. And if you have a home to sell, I just want to mention here that you can sell your home faster and get top of market value with a lot less hassle by using the Cliff Freeman Group's certified pre-owned program. All you got to do is check out www.certifiedpreowned.homes for more information to schedule a call and find out more. There's no cost and no obligation. And oh, by the way, if you happen to be a rockstar real estate agent watching this video and would like to know more about our group, we're looking for exceptional talent right now to join our team. Just reach out to me directly. My cell phone number is 214-680-5403 for a conversation about your future. Once again, that's 214-680-5403. This is Cliff Freeman, and I am forever grateful to have you guys watching our video here. Thank you so much, and reach out to me if you've got a question about this. We are always excited to help. Thank you, and God bless.